Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. Today we're diving into EVgo's latest filing to see if their charging stations are revving up or running on empty. Get ready for some plugged-in insights. EVgo, for those who might not be totally familiar, builds and operates electric vehicle fast charging stations. They're in a sector that's definitely getting a lot of attention with the push towards electric cars. This report we're looking at is a Form 8K. Think of it as an extra unscheduled report that companies have to file when something big and important happens, something that investors need to know about right away. The big event here happened on July 23rd, 2025, which is the earliest date mentioned for any activity in this report. And just a bit of background, EVgo Inc. is incorporated in Delaware, which is a common state for companies to set up in. Their commission file number is 001395572, and their employee identification number is 8523260098. Their main corporate address is here in El Segundo, California, and their main phone number is 877-494-3838. Now, let's talk about what EVgo has listed on stock exchanges. They have their shares of Class A common stock trading on the Nasdaq Global Select Market under the symbol EVGO. They also have redeemable warrants which give people the right to buy their Class A common stock at a price of $11.50. These are traded on the Nasdaq stock market under the symbol EVgo. Warrants can sometimes be a way for companies to raise a bit more money down the line. EVgo falls under the category of an emerging growth company. This means they can take advantage of some regulatory flexibilities, which is pretty common for newer companies. The big news in this filing is about a new agreement. Specifically on July 23rd, 2025, EVgo Voyager Borrower, which is a subsidiary of EVgo Inc., signed a credit agreement. Think of this as a big loan deal. This new agreement is with Sumitomo Mitsui Banking Corporation acting as the main agent for a group of lenders. This credit agreement is for a term facility, meaning a loan that's paid back over a set period, and it's for up to a massive $300 million. That's a lot of dough. Part of this $300 million is a committed term loan facility, meaning $225 million is definitely available if they meet the conditions. This part of the loan is set to mature on July 23rd, 2030. That's about a 5-year term. The other part is a $75 million uncommitted incremental term loan facility. Uncommitted means that this portion isn't guaranteed. It depends on lenders agreeing to provide the funds when EVgo wants them. EVgo can draw down loans under this agreement during an availability period. This period starts now and ends either when they've borrowed 95% of the committed amount or if the commitments are otherwise ended. This gives them flexibility to borrow as needed. On that same July 23rd closing date, they actually made their first request for a loan, which was about $48 million. And they received this initial borrowing on July 24th, 2025. So they've already started drawing down from this credit line. So what's this money for? Well, it's mainly to help cover costs related to building and operating their electric vehicle fast charging stalls. Specifically, it will reimburse the company's subsidiary EVgo Services LLC for up to 60% of these costs. This funding is expected to help build out over 1,900 charging stalls across the country. This includes 15,400 stalls that EVgo is moving from its existing public network to be used as collateral for this loan. This is a significant expansion. Now, about paying this back, starting at the end of the first full quarter after the loan agreement began, EVgo will need to make quarterly payments of both principal and interest to the lenders. This means they'll have to start servicing the debt fairly soon. The loans can be in different forms, either a SOFR loan or an ABR loan. SOFR, or Secured Overnight Financing Rate, is a common benchmark interest rate. ABR is simply the alternate base rate, which is often tied to the prime rate. It's good that they have options for how the interest is calculated. For SOFR loans, the interest rate will be term SOFR plus an extra percentage. For the first 4 years, it's 3,250,525. After the 4th anniversary, the additional rate increases to 3,500. For ABR loans, it's the ABR plus 2 term 50% for the first 4 years. And after 4 years, it goes up to 2,500% plus ABR. These rates are pretty standard for corporate loans, neither exceptionally high nor low. EVgo can choose to pay back the loan early if they want, as long as certain conditions are met, like no defaults happening. But there are also situations mentioned that could force them to make mandatory prepayments. And importantly, this loan is secured. This means lenders have a first priority claim on the borrower's assets and even its ownership interests. It's like putting up collateral to guarantee the loan. For that $75 million uncommitted portion, the specific terms like the repayment date and interest rates will be decided when and if EVgo decides to actually borrow that money. This section just confirms that the credit agreement we just discussed creates a direct financial obligation for EVgo. It's basically saying, yep, this is a real loan and they owe money on it. This next part is about publicity. On July 28th, 2025, EVgo put out a press release announcing this new credit agreement. I've included a copy of that press release with this filing as Exhibit 99.1. It's important to note that the company is saying this press release information isn't considered officially filed under certain securities laws. This is a standard disclosure to avoid certain liabilities. And like most filings, there's a section on forward-looking statements. This is where they talk about what they expect to happen in the future. Usually this includes words like may, will, has, plans, and so on. They're essentially flagging that their future business performance is subject to various risks and uncertainties, and what they say now might change. They are being upfront that statements about future loans, agreement terms, use of proceeds, and avoiding default situations are all forward-looking. They also mentioned that their expectations might not turn out as planned and refer to their other filings for more detailed risk discussions. Standard stuff here. They've attached the press release we just mentioned as Exhibit 99.1, and Exhibit 104 is the interactive data file for the cover page, which is standard for SEC filings nowadays. And the report is signed off by Paul Dobson, the Chief Financial Officer, on July 28th, 2025. So let's break this down. EVgo just secured a significant $300 million credit facility. This is a big deal for a company looking to expand its charging infrastructure. It shows they have the confidence of major banks like Sumitomo Mitsui Banking Corporation. The immediate use of funds up to 60% of build-out costs for over 1,900 charging stalls is a clear signal of their aggressive growth strategy. This isn't just about maintaining their current network, it's about a substantial expansion, aiming for 1,500 new stalls plus an additional 400 from their existing network. This expansion could significantly increase their market share and revenue potential, if demand for EV charging continues to grow as expected. The fact that they immediately drew down $48 million means they are putting this capital to work right away. This suggests operational readiness and a clear plan for deployment. The quarterly payments starting soon are also a good sign of structured financial management. However, it's crucial to remember this is debt. While it fuels growth, it also adds interest expenses and repayment obligations. The rates, while standard, will impact their profitability. The loan is secured by assets, meaning if EVgo can't meet its obligations, those assets could be at risk, which is a key risk to keep an eye on. Overall, this move appears to be a calculated step to accelerate their network expansion. The key for EVgo will be to ensure these new stalls are utilized effectively and generate sufficient revenue to cover the debt service and contribute to profitability. The success of this large loan hinges on EVgo's ability to execute its growth strategy efficiently and capture market demand in the competitive EV charging space. This is a positive development, but a substantial undertaking that will require careful management. What's your take on this $300 million loan and EVgo's expansion plans? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community for more discussions and insights linked in the description. Thanks for watching, and I'll see you in the next video.